Welcome to the channel Finance and Investing for All. Now, if you are new to this channel, please click the subscribe button. Also, comment below and let me know what are the topics you would like me to cover. Today's subject of review is the income statement. Now, an income statement along with a balance sheet and cash flow statement combine to form a company's financial statements. So then, what is an income statement? An income statement details a company's revenue and expenditure during a period of time. That period could be monthly, quarterly, semi-annual, or even a full year. An income statement is also known as a statement of performance, statement of operations, and more commonly, a statement of profit and loss. Now, if you had to look at a statement, it would be simply revenue minus cost, and we get net income. A more expanded definition, however, would be revenue minus cost of goods sold, and you get gross profit. From there, you would deduct operating expenditures and arrive at operating income. After that, you would deduct taxes, interest expense, and other gains and loss to arrive at net profit, also known as the bottom line. We start off with the top line, also known as revenue, turnover, or sales. What is revenue? Well, revenue can be defined as the inflow or amounts that are generated by a business from the distribution of goods or performance of services. Now, there are many types of business entities: manufacturing, construction, services, trading, but it all can be boiled down to performance of a service or distribution of goods. Now, there are many revenue recognition methods, the most common one being the physical delivery of goods or performance of services. There are also other methods such as the percentage of completion method. This is used by the contracting or construction sector, where revenue is determined as a percentage of work completed on a specific project. After revenue comes costs. Now, costs are the amounts incurred to generate the revenue that we just spoke about. There are many types of costs, but the most common and important one is cost of goods sold. Now, cost of goods sold is the cost of producing goods that were ultimately sold during that financial period. There are many components that enter into cost of goods sold, and for a manufacturing concern, that could be labor, materials, subcontractor costs, and depreciation. Now, if we take revenue less that from cost of goods sold, we arrive at gross profit. Gross profit is the earnings generated by a business from its core business activity. This is one of the most important figures on an income statement. After gross profit, we need to deduct operating costs to arrive at operating profit. Now, we already spoke about cost of goods sold, which is the cost attributed to the production of goods and services which form part of the top line. But a business incurs many other costs, such as rent, administrative costs, distribution costs, wages, payroll. Now, these are not specifically tied to the production of goods and services. However, they are costs nevertheless. These are deducted from cost of goods sold to arrive at a very important amount known as operating profit, which outlines the overall health of the business operations. After operating profit, we include items such as other gains or other losses, and then deduct interest expense to arrive at earnings before taxes. From there, we deduct tax expenses to arrive at the bottom line, also known as net income. Now, let me tell you two things about net income. First, net income after declaration of dividends is transferred to a company's balance sheet as retained earnings or equity. Also, remember this very important point. That is, net income does not equal cash. I repeat, net income does not equal cash. I will cover this point in another video. I want to get back to costs and talk about three main items. The first being depreciation expense. Now, depreciation is the gradual write-off of an asset over its useful life. Let me explain this by an example. Let's say a company buys an expensive piece of equipment. Now, given that it is a cost, it can show that on its income statement. However, that will adversely affect its net income, maybe even a loss. So what the company does instead is that it reports that piece of equipment as an asset on the balance sheet. And over its useful life, let's say 10 years for example, it will take a piece of that asset and report it as an expense, rather depreciation expense on its income statement. Therefore, gradually over the asset's useful life, the asset will get transferred from the balance sheet to the income statement in the form of depreciation expense. Next up is other gains and losses. Now these usually are reoccurring or non-reoccurring in nature. Now what non-reoccurring means is, let's say a manufacturing entity decides to dispose an obsolete piece of equipment for a profit or gain. It will show that as an other gain or loss on its income statement. Once again, these could or could not be reoccurring or non-reoccurring in nature. When analyzing an income statement, we need to take care of non-reoccurring items because remember, these do not form part of the core business operations. Finally, we have interest expense, and it is that amount that is paid to the lenders against funds provided by them to the company. Now that we've had a look at the income statement, let's take a snapshot of a real income statement and let's see its elements one by one. So, we have in front of us a sample income statement, where on the top line we can see the company's revenue, less cost of services to arrive at gross profit. Now why cost of services? That's because we're looking at an income statement of a services entity. From there, we deduct administrative and general expenses and selling and marketing expenses to arrive at operating profit. These are categorized as operating costs and also include depreciation expense. Now, depending on the details in note number 11, other income will include both reoccurring and non-reoccurring items. We also see finance costs, also known as interest expense, and we then arrive at a subtotal known as profit before tax or earnings before tax. From there we deduct taxes to arrive at profit for the period or net income, also known as the bottom line. Now I want to direct your attention to the columns over here. On the left side, you will see the company's quarterly performance ending June 30th, 2017 as against June 30th, 2016. On the right-hand columns, you will see the company's 6 months cumulative performance ending June 30th, 2017 versus June 30th, 2016. Now, if we were to briefly analyze the income statement, we would see that revenue has fallen from last year. So has gross profit. So has operating profit. And we see the same with net income. This brings us to an end of our discussion on the income statement. Through a separate video, I will cover the important topic of analyzing an income statement. Now, if you are new to this channel, please click subscribe. Also comment below and let me know what are the topics you would like me to cover. Till then, see you soon.